One of the most commonly used yet least understood concepts in the market is stop loss. Stop loss is a level you set to limit your loss in a trade, and when price reaches that point, your position is automatically closed. In other words, it's designed to protect you from large losses. However, for most investors, stop loss turns from a protection tool into a source of frustration. Because after placing a stop, people often see the price hit that exact level, even take them out of the trade, and then move in their original direction. This makes many people feel like the market is hunting me. In reality, what's happening here is not purely a coincidence, because a large portion of market participants think in similar ways. Most people who learn technical analysis usually place their stop loss below recent lows or above recent highs. This seems logical, because if those levels are broken, the trade idea is considered invalid. But precisely because of this, a large portion of stop orders in the market cluster in the same areas. So without realizing it, everyone places their stops in the same areas, and these zones turn into liquidity pools. In the market, large players, institutions and funds, trading high volumes toss take this liquidity into account when opening positions, because opening a large position all at once can significantly impact the price. That's why they need sufficient counterparty liquidity to enter the market. And this liquidity is often found in the stop-loss orders of retail traders. For this reason, price often moves toward these stop zones. When stops are triggered, a sudden flow of orders enters the market, allowing large players to take their positions more easily. This process is often called liquidity collection. Price first moves to the areas where people get stopped out, collects those orders, and then makes its real move. That's why many investors get taken out of their trades early, even if their analysis is correct. So the problem is usually not predicting the direction wrong, but entering at the wrong place and getting stopped out at the wrong level. The market often moves in the direction that causes the most people to lose, and that's usually where the crowd is. So what should you do in this situation? Not using a stop loss is definitely not the solution. On the contrary, when used correctly, stop loss is one of the most important tools that keeps you in the game long term. But what matters is placing your stop not where everyone else does, but at more logical and less obvious levels. For this, you need to pay attention not only to technical levels, but also to the overall market structure and where liquidity is concentrated. Also, controlling your risk on every trade, keeping losses small and aiming for larger gains, is essential to staying in the game. In conclusion, most people who lose in the market get stopped out at the wrong place. Winners are not just those who predict correctly, but those who manage risk well and use their stops intelligently. Because in the market, survival is far more valuable than being right.